All right, hackers, welcome to The Commit. Today we're talking about stock options. Stock options are a pretty important part of compensation when you're working at a small or private startup. So we've got our CEO Brandon here, who knows a lot more about stock options to tell us about them and sort of what to look for. So Brandon, I guess the first question is, what is a stock option?
Sure. A stock option is the option generally for an employee to purchase shares in the company. And it often is granted by a company at the beginning when you take a job somewhere.
Right, but it's not like you're just granted these shares and you immediately own them.
No, you're granted the option to buy shares generally at a later date after they've gone through what's called a vesting period.
Okay, and so let's talk a little bit more about some of the sort of key terminology.
Sure.
So you're granted some stock options, and then there's this thing called the strike price.
Right. The strike price is the price that's on the paper saying if and when you decide to exercise these options to purchase shares, you will pay this price. And your hope is that if you do exercise them, those shares will be worth at one day much higher than that.
Right, so that's like the buy low price, and then the value that you're hoping for later is the sell high price, and hopefully you get to take home a lot of money in between.
That's right.
All right, so you've been granted shares, you know how much they're going to cost for you to purchase them, but you can't just purchase them all at once.
That's right. There's a thing called the vesting period, which says that generally it's 4 years with a 1-year cliff is pretty standard at startups. And what that means is these options will become available to purchase over a 4-year period. But the 1-year cliff means you can't purchase any of them until you've worked at the company for a year. So these are retention vehicles. So after you've worked a year, you'll have 25% that you can purchase and exercise if you'd like. And then the remaining 36 months are sort of prorated. You have the option based on how long you stay.
Right, so like every month you'll be granted another small percentage of that total.
That's correct.
So what happens if you leave early?
If you leave before the year, you get none. If you leave after the year, then it's however long you've stayed based on that vesting period.
Right, but can you buy those shares, say, 2 years from now, or do you have to buy them sooner?
Well, you can't generally buy them after 90 days when you've left a company. So you can buy them as soon as they are exercisable. But if you've left the company, you have to purchase them within the last 90 days, which means you're probably going to have to figure out whether you have cash in the bank.
Right, so it's something you hopefully will plan ahead for.
Right.
Okay. And then when can you actually sell?
Right. Once you've had what's called an exit or an IPO, so that is a liquidity event. When someone buys your company for a lot of money or when your company goes public, that's when those shares actually become worthwhile and you can trade them on the market, usually after a little holding period.
Right, so a company like Twilio, right, just had a big IPO. Now their employees, now that they have hopefully bought their shares, they'll be able to actually exercise, not just exercise them, but actually sell them.
Right, and that's what you're hoping for. You're hoping for a company like Twilio that goes public. Now keep in mind, 99 out of 100 or perhaps 999 out of 1,000 startups are not going public. So they're an example of where your options actually could really be worth something.
So what are the key things that a developer needs to look for, think about when they're evaluating an offer and they've been given, this is what your number of shares are, this is what, it might be worth in the future, like what is it you really want to look for there?
I think the two most important things are, one, what percent of the company do these options represent? So it's not the number of shares. They'll say, here's 10,000 shares, options for shares. That doesn't matter. What matters is what's the numerator divided by the denominator, which is the total number of shares outstanding that this represents. With that number, you can go online, you can search around, see, well, given I'm a junior developer and this company's been around 10 years, this would be the right percentage. If you just have the number of shares, you can't do that fair comparison. The second thing is I wouldn't spend too much time focused on what are these worth now. It's a private company. Nobody really knows exactly what they're worth. You should be asking, what will it take for this company to succeed? What are the key metrics that they're using? How have they done on those metrics, those business metrics? And do I like this product? Is it a big market? And do I think these could actually be worth something one day?
Right. You're sort of more focused on it appreciating, not just like seeing a big number out there and being like, I'm waiting to get to that number.
Correct.
You want to know that you're going to grow into it. So I think that brings up a good point about sort of equity versus salary. If you believe in the company long term, it sounds like you're saying, then it's a great opportunity to sort of think about options. But how would you sort of make that decision about splitting where you put your sort of risk tolerance?
Right. So these days, the markets for engineers is so high that options are really a bonus. They're not often granted in exchange for a smaller salary. Startups and big companies alike have to pay market rates for great engineers. And then the shares are just on top of that. It's a great way for everybody to work together toward a common goal. So I would say if a company says to you, we're going to give you a greatly reduced salary in exchange for a lot more shares, It's not necessarily you shouldn't take the job there, but you should ask yourself, why is this company unable to pay market rates like other startups are? Or how far off are they from actually having a big exit?
Great. Well, folks, that's what we got for our introduction to stock options. I hope it was helpful, and we'll see you next week. Thanks for watching.
You need to clap?
Do you want to clap this time? You can clap.
You clap.
I'll clap. You gonna clap after I clap?
Maybe.
This is not a call and response.
Maybe.
This is not Cab Calloway.
I'm not promising either way.
But Steve's the one that's got to deal with it, not me. All right, we're good? Yeah.
Are you gonna clap?
I'm gonna let you clap since you seem so excited about
I
it.
don't want to clap.
No. Oh my God.
I don't want to clap.
See, now you're, I'm not gonna say.
Are you 5?
I'm not clapping.
Okay.